Hello options traders, welcome everyone. And I wanted to post a video here, just a quick explanation from a question that I got from one of the traders in the group here. More of a technical question, but he was trading some vertical spreads and noticed that quite often you will see negative bids. And so he was wondering how this happens and how you should trade these positions. So let's take a look at why do some vertical spreads have negative bids and how you should place those trades. First of all, understand that a spread strategy in finance, not necessarily just in options, but in finance means that we are buying an asset and selling another asset against it. There's a lot of different types of spreads, but in options we are generally, not always, but generally buying an option and selling an option against it. And the vertical spread is a type of strategy where we will buy one option, perhaps let's say the January 100 call, and we will sell another against it, maybe the January 105. But they must have the same expiration. They'll have different strikes, but they have to have the same expiration. And if they do, that is a vertical spread. But the key to notice is that the vertical spread quotes are made up of two options. So if you've ever traded options for any length of time, you'll notice that the bid-ask spreads can get quite wide. And the more volatility there is, the wider they get. So if you've got a wide bid-ask spread on one option and a wide bid-ask spread on another, when you look at the combination, they get even wider. So for example, let's say that we have a $100 call with a bid of $290 and an asking price of $3. And at the same time, we have a 105 call. Let's say it has a bid of $1 and an asking price of $1.30. Now the first thing to notice is that when you're dealing with the same expiration, lower strike calls must be worth more money than higher strikes. So because we have the same expiration date here, the 100 calls should be worth more than the 105 calls. And notice if we compare the asking price here of the 100, we have 3 compared to $1.30. So it's definitely more expensive. If we compare the bids, I've got a $290 bid on the 100 call and only a $1 bid on the 105. So it's definitely more expensive. Second thing to notice is that on the 100 call, I have a 10-cent spread between them. That's just the difference between those two. That's what we call the spread. And again, when you're dealing with at-the-money options, you'll usually have fairly tight spreads. As you go further in the money and out of the money, these spreads tend to widen. But right now we have a 10-cent spread. Over on the right, on our 105 call, I have a 30-cent spread. So what you're going to find is that the vertical spread quote for the 100-105 pair will have a 40-cent spread. It's got to be the combination of these two spreads. So let's see how that happens. If I wanted to buy this spread, I would have to buy the $100 call. I'm buying the more valuable option. I would pay $3. And if I sell the 105 call against it, I'm going to receive the bid price of $1. So therefore, my net debit would be $2, just the difference. And that's one of my motivations for doing a spread. I'm reducing the cost. I would have had to pay $3, but now I pay $2. I know it's not a real big difference here in this example, but when you start looking at things like Amazon options that could be $50 or $100 or far more, and people say, I don't want to spend that much on an option, well, sell another one against it. Now we can trade Amazon for $2 or $3. So that's our real motivation, is to reduce the cost of this option. So the asking price on the 100-105 call spread would be $2 in this example. What would the bid be? Well, if I wanted to sell this spread, whether it was selling to open, creating a bear spread, or selling it to close, I would have to buy back my 105 call for $1.30, and I could sell my $100 call for the bid of $290. And therefore, I would get a credit of $1.60 to sell that spread. So therefore, if we looked on our broker's platform at the 100-105 vertical spread, we would see a bid of $1.60 and an asking price of $2. So if you look at the spread here, it is 40 cents, exactly what I said on the previous screen, just the sum of the two individual spreads. So the first thing to notice is that when you're looking at vertical spread quotes, there's nothing really magical about these numbers. It's not like people are going into a separate market and just trading vertical spreads. These prices that you're seeing on your broker's platform are simply just the steps that I just went through. They're going to look at the bid and the offer for the buy and the bid and the offer for the sell, and they're going to just do the math for you. That's all they're doing. And so in this example, we would see a bid of $1.60 and an asking price of $2. However, let's say that these options went in the money and or things got really volatile, but maybe the stock is traded well above our strikes. And so for the $100 call, we now see a bid of $13 and an asking price of $15, $2 spread. The 105 call has a bid of $11 and an asking price of $13.50. Once again, if we compare the bid on the 100 call to the bid on the 105, it's more expensive. And if we compare the asking prices, we see that the offer on the 100 call is greater than the offer on the 105 call. But look at what's going to happen to our quote. If I wanted to buy the spread, I would have to spend $15 for the $100 call, and I could receive $11 for the 105 call. And therefore, I would have to spend $4 for that vertical spread. But if I wanted to sell the spread, I now have to buy the 105 call for $13.50, and I would receive $13 for selling my 100 call. And look at this. We now have a bid price of negative 50 cents. So the thing to notice is that even though my individual bids and offers are greater on the 100 call when compared to the individual bids and offers on the 105, it's not always true when we start mixing them. And the reason for the negative bid here is that the bid on my more valuable option right here is 13, and it has slipped below the asking price on the less valuable option, the 105 call. So as volatility starts to pick up, these spreads will widen, both of them. So the asking price here will start getting pushed up higher, and the bid price here will get pushed lower, and eventually they might cross. And that's what's in fact happened here. Now, while you may see negative bids, you will never see negative offers. And that's because it would create a situation where you and I as retail traders would be an arbitrage. It would be guaranteed money. So when you see the negative bids like this, it just means that things have gotten volatile. These prices are starting to get fairly close on our two options, and they can cross on the bids and offers. So again, in this example, if these were the individual quotes on my 100 and 105 calls, if we went to our broker's platform and laid it out according to vertical spreads, we would see the 100-105 vertical quoted as negative 50 cents, offered at 4. And this would in fact be a $4.50 spread, which is the sum of the individual spreads we just saw. So when you see this, the best way to handle it is that you'll want to trade between the bid and the offer. And that's called the mark, or sometimes called the midpoint, and every brokerage platform should show it to you. So even though mathematically it means that you would have to pay 50 cents to sell a long spread, nobody really expects that to happen. Nobody's going to do that. And that's what throws new traders. They see this negative bid and they say, what in the world are they trying to do? It's just because the spread on the individual options have gotten so wide. So let's go over to the E-Trade platform and take a look at some examples. All right, so here we are in the E-Trade platform, and let's use Amazon since I was just talking about that one. Another big down day for Amazon, down over 22 points, trading at about 1733. Now I have the platform set to individual calls and puts up here. And let's come down below, and you can see that this is an in-the-money option here. This is a 1340 strike. So this is almost 400 points in the money. And look at these bids and offers. Very expensive. Lots of money you got to shell out for these. And as we start scrolling down, we'll see as we get closer to the 1730 mark, the at-the-moneys. Look at this. Still $85, and it has 15 days till expiration. Extremely expensive options. This is a great time for using a vertical spread. If you like Amazon and you're trying to make a play on Amazon, don't go to your second and third and fourth best pick just because they're cheaper. Find a way to make it work. Options are wonderful tools for this. I'm going to go up here for my drop-down menu and select vertical spread. And now you should understand that these quotes are nothing more than the individual bids and offers from the previous screen. So because of Amazon's price, sometimes these are going to trade $10 wide, sometimes $2.50, $5 wide, it depends. But right now these are $10 wide. And when you're dealing with strikes that are $10 wide, it's going to be really tough to see negative bids and offers because the individual quotes are so far apart. But notice that when we get down here, here's a 1770, 1772.5. They're $2.50 apart. We have a negative bid. So I'm going to change my spread here to 2. And now these will be 5 points wide. I'm looking at the 1770, 1775 vertical. Look at this, negative bid. Now this is an out-of-the-money spread because the stock's at 1737. This is again the 1770-75 spread. So you will typically see these bids go negative when you're dealing with out-of-the-money verticals or very deep in the money. So let's see if we can hunt some more down here further out of the money. Actually, all of them look like they've gone negative here, and that's just because of the volatility with Amazon. So you can see quite large spreads. What if we go super deep in the money? Let's see if we can find some here. We might have to go to 1 wide again. Not really any negative spreads down here. Oh, there we just had some that popped up for just a flash. But the point that I'm trying to show is that you will really almost never see them for at the monies. So if you're dealing with the 1730-ish range here, now again, these are 10 points apart, so yeah, those definitely aren't going to go negative. But if they were 5 points apart on Amazon, we might see them go negative. So again, down here, these are 2.5 points apart. You can see negative bids. So the point is, how do we deal with this? What should we do? Well, very simply, just look at the mark right here. That is the halfway point between the bid and the ask. So if you take the bid plus the ask and divide by 2, that's what that number is. It is also the mathematical midpoint. If we took the midpoint of the individual options and subtracted them, we would get the same number. So if you were placing a trade, let's say for this spread right here, the 1772.5, 1775, you're not going to place an order for negative $1.65. You would place it for $1.10. And in most cases, that's going to fill almost immediately. You'll find that that's always true for any vertical spread. You should always be trading at the mark. And there's reasons for that. I've talked about it with the box spread. That will almost always go immediately. For those who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. And also please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.